Hey man, Preet, how's it going today?
Hey Dan, I'm good. How about yourself?
I'm doing all right. Enjoying a little bit of sunshine out here in California today, for
Uh,
once.
that's, that's nice. I'm in Western New York, so we got a good sun today, the entire day. So it's kind of a luxury for me, to be honest.
Is it?
Yes, it is because yesterday was a crappy weather.
Has it been a little bit warmer than usual for you guys out that way, or
Yes, it is warmer today.
yeah?
Yes.
But overall, how's the winter been for you?
Well, winters, except for the snowstorms, it was okay. It was kind of cold, when it's not snowing. But when it gets slapped with snow, the weather is not, the temperature is not too bad after that. But yeah, overall, I think I would say it was better than previous years.
Okay. Yeah, I watched I'm a San Francisco Giants fan, so I was watching the Giants and Yankees game today. I guess it was 39 out there in New York today, so a little cold.
Yep.
How we doing? Guess we're the only ones here.
Hey, Josh.
Hey,
How's it going, Josh?
doing good. I don't see anybody. I got that gallery on. There we go.
Good afternoon.
Hey, Steven.
Hey, Steven.
Hello. I got your message, Dan. I'll give you a call after this meeting.
Okay, yeah, no worries. Sounds good. Thank you.
Yep. All right. Well, it's 3:01. We'll go ahead and get started. Christine, if you want to share your screen and pull up the presentation, we got a couple of properties that we want to look at, one of which I believe Manpreet had shared with us in Savannah, Georgia. All right, I'm gonna drop on my phone and join from my computer. Okay, you guys hear me okay?
Yep.
All right, fantastic. This is a opportunity that was brought to us by Manpreet. This is a portfolio, 2 properties in Savannah, Georgia. The addresses are there up on the screen. Looks like, Manpreet, do you know how close they are to one another?
I think I don't remember it on the top of my head, but yeah, they're pretty close to the proximity to each other.
Okay. Let's go on to the next page. We'll go through this, the pitch deck. So property 1, this one is at 6 Gateway Boulevard, is the Econo Lodge, built in 87. This is under a franchise, so we would ask the seller to release that flag. Looks like it was renovated last in 2001, so certainly a prime candidate to be repurposed for multifamily. Has 119 keys. It's a 2-story exterior hotel with about 118 parking spaces on 2.76 acres in zone PBC. And we have some information on the zoning as well. We'll jump into that in just a second. And then property number 2, which is a red roof, also under franchise, built in 84. Looks like this one has 101 rooms. It is also a 2-story exterior garden style hotel, has a meeting space. It looks like also very similar as far as footprint for acreage. Zoning is similar. It does have a differentiator. It's PUD ISB. I'm not sure exactly what that means, but we can certainly jump into that a little later. Has 120 surface parking spaces. And again, very close to one another. So it could be a good portfolio that we could look at. Let's go into the next page.
Yeah, Stephen, before you move on, they're both 8 miles apart. So
8 miles apart. Okay. So close, but not too close. So here is the plan here. We got 2 hotels, 233 total units, and we're looking to redevelop this project. Let's go to the next page. Here are some pictures of each of the assets. Looks like they've done some repairs to the asphalt. Looks like the asphalt's in decent shape. Roof looks like it's been recently replaced, although I would not be able to confirm that until I was on site. Looks like the lobby is kind of in great shape as well. Looks like it's got some OSB laminate flooring. Next page. And here is the Econo Lodge. Looks like a tile roof, nice grounds, pool, lots of amenity space, an overall good looking asset. Next page. All right, so here we are here. So property details, parcel view. This is the 114 key property at 11750 Abercorn Street. Looks like the rooms are a little on the smaller size, 288 squares, a total of 300, actually about 32,000 total rental square footage. And then this is where the rents were actually provided in the OM, which is nice. So they're saying that you could rent these units for about $950 or $3.30 per square foot. Next page. And here's another rental comp for the sister property. Again, 119 studios would be the goal. A little smaller in the square footage, 260 squares. Very similar in building size and rent as far as the square foot of the rent per square foot. And as you can see, the outline on the right hand is actually the actual property overview, which shows its footprint, and it looks like it's sharing possibly some space with the adjacent property on the right, but we'd have to dive into that a little deeper. It doesn't look like there's any access to that property within our subject property, but something we can certainly discuss if we were to move forward. I do see Some storage to the left. I'm not sure if that's industrial, some light industrial to the left of the property, but we can certainly dive into deeper if it warrants us to be on site and doing a site visit. Next page. And here's the 8 miles that you're referring to, Manpreet. It looks like it's along the 204. The one property, let's see here. 1, 2, where are the properties here? Am I Six Flags? No, those are not the properties. Where are the properties?
These two are the subject property.
Okay.
They already changed
They changed the names.
when it is, yeah.
Okay, got it. Were they looking to, or were this in the process of being a conversion, Manpreet, you know?
So no, not that I know of. Yeah, I didn't find that information at all that, the conversion is in process. Again, I know Christina also asked me about the pricing guidance. I reached out to the brokers, but I think at this point they're kind of gauging the market on what kind of price would they be get offered upon for these properties. So
Okay, so there was, I believe there was no price, right? It was just kind of a, what can we do as far as underwriting goes? Was there no pricing guidance, Manpreet, as far as each
yeah,
asset?
no price, no pricing guidance.
No pricing guidance. Okay, next page. So here's the overview of the zoning. It's zoning by right. So it looks like the property is currently zoned OI-E. In order to us to get to 114 multifamily units, we'll have to have that rezoned to RMF. Not sure exactly what that process looks like, but it looks the timeline has been mapped out to be a 12 to 14 week process. There's a pre-app meeting, local planning commission hearing, and of course, finally, the mayor and the city council hearing. We do have some contact information that we can certainly leverage if we were to move forward on this project, which is great. And it looks like the process is similar for the sister property, 12 to 14 weeks from application to approvals. And I'm imagining the process is going to be very similar, although the zoning on the earlier pages indicated that it's slightly different. So let's go to the next page. And we get some rent comps. So here are some rent comps for both properties, the sizes, you'll see on the square footage. Always remember when running comps, you want to look at like for like. So try to find an apartment complex that's very similar to your hospitality subject property. Most importantly, the square footage of the rooms. Keep in mind, we're looking to convert into efficiency studios. So these are smaller than typical studios. But again, this gives us a good insight as far as what some of the neighboring properties are charging. Looks like there's a property not too far away that's getting around $317 a square foot. And it was built in 87. So I would imagine there hasn't been any recent renovations. So we should be able to push the rent and get somewhere north of $3 and say 20 cents. Next page. And this is where kind of I live and die on these opportunities, is I like to look at the analytics. First and foremost, I like to look at the demand in the area. So at the bottom right-hand quadrant of this page, you'll see that the 12-month absorption of units is kind of low. So if we were to come to market with 200 plus units, it's going to take potentially some time to lease up. Although this data could be a little aged, but certainly something we want to do some further research on, whether it's calling the comps and finding out if there's a wait list, et cetera, et cetera. It looks like the real population push is in our seniors. So it looks like population growth is growing from 40 to 55 plus. Although the younger generation seems like they're leaving. So just something to take in mind when looking at these properties. Could be a good push for senior housing, 55 plus. Something to consider if you haven't done so already. It could be a great 55 plus community. Although typically with 55 plus, you're going to want to have some 2 bedrooms. Because typically if they're a married couple, they're going to want to stay together. So keep that in mind. Looking at the rents in CoStar, seem to be in line with the comps that were provided. And I'm really liking the exit price per unit at 215,000. So those are some positive numbers there. My only concern would be just digging down a little deeper and just firming up the absorption and as well as the population growth and seeing where the vacancies sit. Right now, they're saying in this market and the 2 to 4 star vacancies around 7%. Any questions on this page?
Yes, Steven, so this is these are the stats derived from CoStar for the Q1 2023 data. This is Q4 2022.
Say it one more time.
These stats that are on the screen right now, these are the numbers extracted coming from Q1 2023 data or Q2 2022. Oh,
This
sorry,
is-
Q4 2022.
Yeah, this is recent. This is a recent pull from CoStar. So I'm not exactly sure when CoStar has updated their data, but this is a recent pull from CoStar.
Okay.
And it's actually using the comp that was in the OM, the 1425 King George Boulevard. So you'll see that particular subject property has 89 units and its vacancy is really low at 1.5%.
Got it.
But keep in mind, their asking rent per square foot is $1 off where we would want to be. Okay.
Yep.
Next page. And here's another map kind of showing where each property lies. So if we were to, tackle both projects, we could obviously order supplies in bulk, use one property as a distribution center as far as storing materials, et cetera, et cetera. It's close enough where we'd be able to realize some economies of scale there. Next page. Let's jump into the underwriting. So this particular deal pencils at 5 million, and 5 million being for the portfolio. So this would be for both hotels. And we used on the top right-hand side, the actual rates that were given to us of $3.30 per square feet. So you can see what the rate per month would be on those units. And this would be realizing 233 doors. And so this is a $5 million purchase price with a 2% acquisition fee, closing cost averaging out around 25 grand. So we're looking at around $21,000 per key. And then Christine, what do we have for CapEx per key?
25,000.
So we went a little on the higher side. I like to typically kind of stress the deal to ensure that we have enough renovation budget to realize a successful project. I'm going to go up. Where are you going?
Sorry,
Christine?
sorry.
Back up. All right.
Yeah.
So at a $5 million purchase price, you're looking at a profit on the leverage side of $6.9 million with a 24% IRR, and most importantly, a 2.32 equity multiplier and a refi capital return of just under 100%. Any questions there, Manpreet? Do you know whether or not the broker would bite at that $5 million purchase price, or do you want to reach out and see if they'd want to transact at that number for both properties?
Yeah, I'll reach out to them tomorrow and I'll check the pulse on the price if we are in kind of what they're expecting for this thing, or if they have any other expectations from the sellers of both properties.
Ask if they have any offers too, right? See if there's any offers coming in and where those offers are at, because that's going to drive whether or not they're willing to transact at 5 million.
You're paying 6.8% on property management plus the payroll.
Yes.
That's usually I would see a 3% property management plus the payroll. Seems a little bit high, is it not?
Again, we like to, stress the deal until we actually firm this up and get it under contract. We can then reach out to, a property management company to kind of firm that up.
I like that.
But again, it's better to be a little high than be a little low.
I totally agree.
So 21K per key, and the purchase price, the acquisition cost for the per key, and then 25K per door renovation cost. So I think the all-in price is at 47K per door, right?
Correct.
Are you all going to do any rubs billing back to the tenants for utilities?
Probably not at this price point, probably not at the first year of release. With that vacancy being kind of on the higher side and the absorption rate being on the lower side, I would probably say we're going to be all in at $3.30 per square foot, including utilities.
Got it. Maybe get it stabilized and then add that
Precisely.
down the road. Got it.
Yep, precisely. That would be my recommendation. Good questions. Any other questions? All right, let's jump on to the next page. So here's our overall analysis on this project. Again, low absorption rate, certainly a concern. Population growth is kind of moving in the direction that we don't like to see it in. Although at a $5 billion purchase price for the portfolio, we could certainly make it work. Would you agree, Manpreet, as far as the absorption rate and population growth?
No, I agree over there. The population growth for the certain age group that we saw from the CoStar. Yep, no questions over there.
Yeah. So just keep in mind, we just have to kind of put ourselves in the shoes of our investors.
Yep.
And we're going to have these conversations if and when we're under contract, why they should invest in Savannah, Georgia. Typically, you want your investor to kind of fall in love with the market first, right? Project second, or in some cases, the market first, the general partnership or group second, then the project third. So a lot of people will kind of lead off with the underwriting first, and that's not necessarily the best way to go. You want to understand the market and why it's a great market to invest in. And so those a strong absorption rate and high population growth is key, especially with converting an asset class and being such a heavy lift. You want to make sure that you have those fundamental numbers in your corner when presenting this to investors.
I agree. No, this is good. Thanks, Stephen, for these nuggets over here about the absorption rate, the population growth in the certain category, and of course the three-step approach about the market being first, the GP team being second, and then the third, the underwriting of the property. So
great. All right, moving on to the next one.
Just have a quick question.
Yes, Josh.
Stephen,
Or Spinny. Yes.
can you please go back to the last slide for me, please?
Yeah, Christine, can you back off one? Yes.
So a couple of questions here. Do you know what's going on behind the negative population growth? Is that due to the jobs leaving the site, or is there anything that you guys know about?
Without really understanding the market personally, it could be a number of different factors. It could be a matter of, jobs leaving an area, right? So we see that a lot in California.
Mhm.
It could be a matter of, an economic downturn in a particular market.
Mhm.
It could be a large employer that just left the marketplace. It really could be a number of different reasons. And I think if we were to move forward with this project, that's one thing we'd want to, get our arms around really quickly to understand the potential for this market. I always try to tell my team and anyone who's looking to go into this type of business to kind of work in emerging markets. So those emerging markets are typically tertiary markets outside of major cities that are just poised for major growth. Because that's one thing you really can't underwrite is an emerging market. You can't really add those factors into your underwriting, but certainly will come to the table when you flip this project in 2 to 5 years.
Because in my mind, I mean, I have an untrained mind, so just keep it in mind. But in my mind, you know, if we have a negative in population growth, that means it's an uphill battle to be able to raise the rent, right? Because you're gonna have
Precisely.
more
Precisely.
availability in the area.
Yep, precisely. And
So-
that's why I was just cautioning Manpreet on this particular project, based upon the low absorption and the population growth not looking so enticing. I typically like to see double-digit numbers on the population growth is a good indicator as far as being a green flag. And then as far as absorption rate, anything north of, say, 1,000 units on an annual basis being leased up. And those on the call who doesn't know really what an absorption rate is typically the number of apartments being leased during an annual period. So for example, if we were to release both of these properties to the market, we have 233 studios. With the number being shown on CoStar, it would take us a little over 2 years to fill both complexes.
Oh, wow.
Would these be used in conjunction with like short-term rentals as well, like fully furnished, like extended stays?
What was your question?
Would these be used for like extended stays as well, or is it?
You could. I think the purpose and the goal here is to convert from hospitality to multifamily. So rezoning to multifamily and then stabilizing as long-term lease ups, right? Because there's a lot less management costs associated with multifamily than there are with, for example, hospitality, right?
With the low absorption rate, would this be a secondary choice for someone to live in versus, say, an available unit down the road that might be leasing for the same price?
It could be.
I say that because the rental rates are $3 per square foot, 3+. So we're being competitive with what's already out there on the market, but we've got, it looks like it's a tighter space.
Not if you look at the comps. So Christine, if you can scroll back to the rental comps, you'll see a number of properties with studio spaces very similar in size. One more back, Christina. Right there. So you'll see Kings Colony, Stillwater, Townwoods, they all have
perfect,
relatively similar size units, and these are all studios. And you can see what they're asking for as far as rent.
Got it.
Whether or not these properties are, conversions like hospitality to multifamily, don't know. That would be another great indicator if we were able to find a property that was converted. That would be obviously the perfect comp. But this is, in this case, the next best thing.
Does CoStar, does it have the occupancy on these properties, or it would probably be outdated anyways?
I mean, it has a general average, but your best bet is to use that average. And then if you were wanting to transact and move forward, reaching out to the property management companies at these various properties would give you some additional insight.
Got it.
But then keep in mind, this is what I would like to call, back of the napkin underwriting to see whether or not it has that green light go, And if it does, then that's when you start digging in a little deeper. And then if it looks even better as you dig in deeper, then you try to get it under LOI. And once you get under letter of intent, booking a flight out there and actually walking the asset with some general contractors so you can shore up your CapEx and see what it exactly will cost per door. That's when you start to dig in a little deeper. But right now we're kind of doing like a 10,000 foot overview of a potential asset that could be a conversion opportunity.
Got it.
And that's pretty much the preface of these calls, is to look at example properties, talk through them, see if it's something worth pursuing. If so, why? And if it's something not worth pursuing, if so, why? So therefore we could kind of all learn on this call on, if something came across our plate, you could quickly look at it and assess just through these repetitions every Thursday, to quickly understand which is something that you want to chase after or not. Because, you know, time is our most valuable asset. Smitty, you still have your hand up. I'm wondering if you just kind of forgot that up, or if you have another question, you know, shout out. Okay, cool.
Maybe just a quick question. This deal was found by Manpreet, correct?
Yeah, he shared this opportunity with us last week.
Oh, got it. So just a very quick question from him. Like, you know, I'm sure you look at so many deals every single day. What will make this deal unique? Like, why was this deal brought up to this call? Just out of curiosity, like I want to train my mind and my eyes to look for this kind of deal. So what are the like 1 or 2 things that you immediately know, like this is something that could work?
Yeah, so Smithy, for me, I think this deal, when it landed into my inbox from the broker, it was like this is something that they already know or looking to convert to multifamily. And they, while reviewing the OM, they had provided the city context and whatnot. So seems like they're kind of on the same wavelength. So that's why I wanted to bring in into this call to kind of look at it. The way Stephen pointed out about certain parameters about the population growth, the absorption rate, right? And what is the initial price at which it will pencil out.
Okay, got it. Now, have you guys, how many projects have you guys done in terms of conversion?
I'm working on my 4th conversion.
Oh, wow. Okay. So you're the man with experience. That's awesome.
I like to think so. I'm always, you know, learning. I've also expanded into other asset classes as well.
Yeah.
I think we're going to see more of this in the near future, whether it's shopping malls, office space, retail space. These are, you know, archaic commercial assets that are going to be probably repurposed in the near future. So this is, you know, I've kind of created a little niche for myself, and this is my passion, is converting distressed commercial assets and repurposing them to the highest and best use.
Wow, that's amazing. Great, thank you.
David, have you done any ground up development for self-storage?
Are you asking me if I have done any ground up development? No, not yet. You know, Nick on my team is working on retail to self-storage. So we're looking at Kmart's that have gone out of business, you know, Sears, all those big box retailers that have kind of fall by the wayside due to, you know, the pandemic and Amazon and what have you. So we're really looking at those conversion opportunities, because similar to this hospitality to multifamily, you're able to get a really decent price point. And then, of course, it's just a matter of then carving that box up into self-storage units. And then,
Is the, oh, sorry.
okay.
I was going to ask, is that also the purpose of this call is also looking for investors? Like, are you guys looking for money?
Oh yeah.
Always.
Oh, yeah.
What's
Always.
the minimum? What's the minimum that people can get their hands on in here?
Typically it's about 50,000 is the typical minimum investment. Although we can, you know, take quantities in smaller denominations, but typically it's like 50 grand.
Does that include any equity to the deal as well, or?
Oh yeah.
Oh, there's equity as well.
Equity as well.
Oh, great. Okay.
You would be a LP, limited partner.
Yep.
Your percentage of ownership would be based on how much you put in the deal.
Exactly.
Oh, okay. That's great to know.
And we do a 70-30 split, so 30 to the GP and 70% to the LP.
And maybe a promote if you reach a certain IRR.
Yep. And some accelerators there as well.
Yeah.
And keep in mind, we heavily stress these deals, so the returns that you're seeing are very, very conservative for good reasons. And so if you are interested in participating in our next conversion, we just put the Opal Hotel under contract in Altamont Springs. It's a 260 key hotel. We'll be flying out there on Thursday, April 6th, and walking the asset on the 7th, meeting with various different GCs. But amazing returns, amazing projects. Altamont Springs is a suburb just north of Orlando. So, I mean, do I need to say any more there? The market is
Mhm.
on fire.
Wow. Would it be possible for you to send me that Opal? I just want to kind of learn about it. And
Yeah, if you want to put your email in the chat, Christine will add you to my database as a potential investor, and she will email you the Opal Hotel pitch deck.
great.
You can look that over, and if you have any questions, you can schedule a call with either myself or the GP team, and we can jump into it. We're not really officially raising LP capital just yet because we don't want individuals' capital kind of sitting, because obviously it's a process to rezone and get the approvals with the city. So I think we'll start pushing for investor capital maybe in a month or two. But we just raised the EMD within 24 hours. We raised 800K for the EMD, which is 2.5 times more than what we needed.
Oh, wow.
But yeah, this is a great project. I'll send you the pitch deck, and if you're interested, let me know.
Yeah, certainly. Thank you so
Yeah,
much.
My pleasure. And we had another project. I think we'll push that other project in Indiana till next week, because we're running a little short on time, and I want Nick to be able to share his retail to self-storage opportunities. So if you don't have any other questions on the first half of the presentation, we'll jump into the second half. What's going on, Nick?
Not too much. How's everyone doing this afternoon?
Great. Thank you.
Fantastic.
Love
Very
it.
good.
Good find there, man, Preet. That's Georgia's, I think, has some pockets in there where there's feasible projects out there, but the KPIs look good. I know there's some challenges, population absorption growth or absorption rate, but wanted to commend you on that find and encourage the group to take a look at everything. One of the biggest things that have helped me through this process is just continuing to scout, learn from the deals that don't work and get closer to the deals that do.
Exactly. So yeah, thanks for that, Nick. Just trying to get that muscle extended and a workout. So
Absolutely. Well, we're going to jump in, guys. I have some exciting stuff for you guys today. We're going to take a different look at the retail conversion and another side of it, which we do with multifamily as well, which is a value add play. So for today, I'm going to dive into one, maybe two properties that are existing self-storage facilities that are stabilized or near stabilized and have the potential for expansion, and demonstrate how you can get the same returns with this process as you would from a conversion process. And this is kind of a new lane. I want to expand your guys' thinking and ability to search different assets. In multifamily, it's a little bit more competitive for finding an apartment, looking for a value add, because there's a lot of people in that avenue. But with the self-storage, there's a little bit more applicability with it. And as I've done my hunting, I'm looking both at existing retail buildings that can be converted into self-storage, as well as existing self-storage that may be a Class C, Class B facility with upgrade potential. Maybe they're mismanaged. They don't have a proper website or marketing efforts, things where you can either increase the rental rates over time, as well as expand on the existing property itself. You'll find a lot of developers will come in, get the first phase of the buildings done, stabilize it, and look for a quick flip to get their money back out. And if it makes sense, this is a great opportunity to come in, finish the project, and maximize the returns for both yourself and the investors. The first one to dive into today is 713 Turnerfield Road, Albany, Georgia. So we got the Georgia theme here today. This one was actually just completed in Q4 of 2022, and it consists of 40,000 existing square feet of self-storage with vehicle storage on the property as well, and an expansion portion. It came on the market 34 days ago. You can see in the 3 mile that there is a huge demand at only 2 square foot per capita versus State Almanac at 6.69. While the 5 mile has a little bit more saturation above the bar that we'd like, there's only a 20% representation of climate controlled versus non-climate controlled. So we'll utilize this kind of metric here to get granular with it and identify or discount competitors, whether they're a distressed or age asset, or they don't have the offerings that the area might need. So when looking at the split between climate controlled, non-climate controlled, a 1-to-1 ratio would indicate that it's a pretty saturated market. In this case, we have a 5-to-1 variance on it. Rates on here are modest at 86 and 128 for a 10 by 10, but still applicable. Smaller population size. And here you can see negative population growth, just like with Manpreet's property, this is something that I'm drilling into to understand, because in the marketing brochure or flyer, the broker was discussing new multifamily developments in the area, as well as retailers like Walmart, Target, et cetera, coming through. So it could be just location of this outskirts of town where that sample size on a 3 and 5 mile radius isn't really indicative of the growth, and there could still be adequate demand. We'll see at the end of this, the underwriting, but this property pencil at $5 million for a 30% IRR, and we'll go from there. Getting a general view of the area, you can see the asset in question. This view here does not show the development that has been on the property, but we can see 82 and Highway 19. So anytime you can be adjacent to high traffic roads, freeways, interstates, it's going to be increased visibility, demand, and help with that lease up period for the property. You can see here it's kind of located more on the outskirts, undeveloped area, and then adjacent to it is some more residential area to the west as well as the north, which is going to be ideal for capturing market share, having these people come out here for their storage. One of the benefits of an existing self-storage facility is we don't have the battle of rezoning, conditional use permits, or special use permits. Taking a closer look here, this is just some of the investment highlights from the posting on Crexy. We can see where they talk about multifamily developments have opened in the past year, Walmart, grocery stores, et cetera. So anytime we're seeing multifamily or any kind of residential development, that's going to be an ideal place to develop your self-storage site where we'll expect to see increased growth and demand over time. If there is an area that's maybe a little bit saturated from a square foot per capita side, we can buffer against that with future population growth, or as these facilities open up and lease up to be a supporting business. I'll let you guys kind of just scan through some of the other investment highlights. Whenever I'm scouting properties, first thing I'm going to is what's the population of the area to qualify it, and then taking a look at what the broker has laid out. For some of these self-storage facilities, they'll already have it broken down into what expansion is available, giving you exact square footages, plans, means, permits already done. Some brokers will just post it raw, and it's up to you to kind of do your due diligence to figure it out. Getting a closer look at the property here, an aerial shot from the south, you can see the existing self-storage facilities. All three of these are in fact complete right now in the process of being leased up. There's the RV and boat that is also developed. And then this would be the expansion potential for additional self-storage with a 2 square feet per capita in this area. Doubling the size of the storage facility would still be permissible and not exceed the demand for that area. One thing we have to look closer at is the RV and boat parking. With a median household income of about $45,000 for this area, it's a little bit low to suggest that there's going to be a population that has RV boats, different types of toys to store here. So a quick search of, maybe a 10 to 20 mile radius of any kind of vehicle storage in the area, just doing grassroots campaigns, reaching out to those places, inquiring about saturation, wait list, promotions to get an idea of how much demand is in that area, where are we seeing these individuals come from. Unlike self-storage, vehicle storage is a little bit more sparse, so people will travel greater distances to utilize this. In the case of a Class A facility, like what we plan to develop here, we'll attract people, maybe if there's an affluent pocket nearby out in a 10-mile radius, where those people will be coming over to store their vehicles here. Again, it's always going to come down to further research, more inquiry. You want to really become a subject matter expert of the area that you're operating in. And that's why it pays dividends to have those emerging markets or that sniper focus on a particular area. Just taking a look through the photo gallery here, we can see the warehouse style self-storage units with external doors. And then inside here, we can see some of the hallway units that we would traditionally expect with indoor self-storage here. The asset is brand new, so everything's in good condition. Paving's brand new, which is ideal. As we look towards the competitor landscape here, you can see the subject property in question, as well as any adjacent competitors. On a 5-mile radius, there's only one new project underway. And then most of the competitors are out towards that 4 or 5 mile radius, making this the only one available within that 3 mile, which is ideal. As we kind of scan the rates here, we can see that average of 128. However, If we look at the last 3 to 6 months, we can see a steady increase in prices, which indicates further demands, the emergence of some sort of force that's driving that price up, which is ideal. So at 140 for the prior month here, it's going to be ideal. From this, we can get granular and look at comps, just like with multifamily, and identify, a property that's built maybe in 2019 or newer, and look at their rental rates to get a more accurate representation for the underwriting. These rates here represent average for everything in this 5 mile radius. So in Radius Plus, you can pull individual competitors here, see the exact square footage, climate mix, as well as what year they were developed. Diving further into the property, we can see a site plan here. We have the 3 existing assets that are identical with 108 units, as well as 102 RV and boat storage units developed, and the expansion potential over here. This is where you have to really go forward with critical thinking on how do we best utilize the space? What's the expansion potential? How's that CapEx going to impact the underwriting versus the rates that we can get? And you'll see in the model that I generated here that I went conservative and just looked at adding 2 additional units like this on this portion of the property, where they continue to be horizontal like this or vertically orientated, won't matter. But we have enough square footage in this expansion potential to at least accommodate 2, if not 3 of these units. And we're not limited by the size or shape of them. We can get creative on how we set this up. It's really going to come down to what the traffic flow is going to look like and how we can best maximize the land. As we get further into the LOI negotiations, bring under contract, that's where we'll bring in architects, engineers, and really hash out how we're going to best divide this up, unit mixes, etc. You can see the property sits on a total of 8.6 acres, making it ideal for that expansion potential here. And this came from the OM supplied by the broker. You can see some of the KPIs for population, median household income, etc. As I approach the underwriting here, I utilize the income expenses assumptions made by the broker, taking a look at the $52 per square foot. This is on an annual basis. So backing that out, dividing it by 12, looking at the average monthly rental rate for all 40,000 square feet of the property, I bake that into our underwriting and then look to expand from there. Also, not pictured on here, but they have an expanded operating expense ratio that forecasts over the next 7 years. I look to average that out into our underwriting to make sure that matches up, just like we saw with the multifamily. Pardon me. Pictured here is just the inputs. There's 324 existing units, and we'd be looking to add an additional 276, bringing the total to 600 total. This would bring the total rentable square feet up to 75,000, which is well within range for a Class A facility that we'd want to see. As I dive into underwriting here, please reach out, raise your hand. I can't see you guys right now in presentation mode, so come off mute. I love questions, or we can get a really good dialogue going here. The first thing to note is the existing self-storage itself. So averaging the rate of $1.38 per square foot per month amongst the 324 units and the 40,000 plus square feet, we saw an average rate of 172, average square footage of 125 amongst those 324 units, generating our first layer of revenue stream. For the 102 parking spots here, I used 27 cents a square foot for uncovered parking. We can see it as high as maybe 30 to 33 cents per square foot for uncovered, and as high as 70 cents to $1 for canopy covered parking. In this case, it being uncovered, we took an average rate of 108, average square footage of 400 per spot, and 102 units, represent the second layer of revenue streams on the property that's existing. And then finally, these top cells here represent the 4 different unit sizes for the property. And you can see the percentage of unit mix for each one of these sizes. And we just plug in the rates as well as the quantity, square footage. And this would be the expansion potential that we're looking at, which brings the total revenue per year at 1.2 million. One thing to note at the top is the lease up duration. In multifamily, we'll look at anywhere from a 9 to maybe 12-month lease up period. Self-storage is going to take a little bit longer. If it was a completely new development, it might take as high as 30 to 32 months to lease up. It could be much quicker. It just depends on the saturation of the market. Because this asset is in the process of stabilization and based on our timeline for ownership, I modeled it on a 20-month lease up duration. That's pictured up here. This is a very important thing to understand when doing your underwriting because swaying this number can dramatically impact returns, IRR, et cetera. And that'll be juxtaposed with the refinance period as well. So how long you're carrying that debt, the higher interest loan of an unstabilized asset or a bridge loan will impact your numbers greatly. The only thing that really trumps that would actually be the rates and the revenue flow itself. I'm going to pause.
I got a
pause
question
there.
for you, Nick.
Yeah.
I noticed that you have pre-leased at 0%. Now, since some of this is existing, would you not add that in as pre-leased?
Yeah, that's actually a really good point. Upon talking with a broker, I'm going to understand where their economic and total occupancy is at, and I'll actually go back in and vary that. So great call out there, Stephen.
Perfect.
Does that make sense to everyone? Stephen's question.
So I got a question over there for you, Nick. So the pre-lease, when you're gonna go ahead and talk to the broker, it will be mostly geared towards the economic occupancy of the facility or physical occupancy?
I would utilize the physical occupancy. The difference between the two is what the market rates would bear versus how much is actually leased up. So if it's a brand new facility, sometimes they'll offer special promotions, reduce rates to capture a large market share, and then shift the rates over time to increase it. But I would use the physical occupancy right now, so that would have more accurate rendering on what is actually available to still lease versus the economic.
Got it.
You can make adjustments to the rate here based on the economic side. So let's say it's at a 60% economic lease up. I would maybe discount this by 40% or the applicable number, and then plug in the pre-lease for the physical occupancy. Some of that's subjective, and that's where you have to kind of marry the science and the art of underwriting together. One thing to point out with self-storage, if it's a brand new facility, unoccupied, there wouldn't be a pre-lease like we'd see in multifamily. No one's prepaying for their self-storage unit before they get access to it. Other questions?
And Nick, where can I see the cash flow? So I see the rent coming in is 105 per month.
At the bottom right here, summary of types. So we'll have the total rent per year.
How about the expense? Like, what's the cash flow on this?
Oh, like NOI and everything?
Yeah, net income monthly.
So I didn't input the expense ratios on this. Typically for self-storage, we're going to realize maybe between 33 and 39% of net revenues in terms of cost.
Okay.
So in this case, if our revenue stream is at 1.2 million, we can probably expect to see this property cash flow around 700,000 to 800,000 per year.
Divided by 12.
Yep. So we'd maybe see about 60 to 70,000 per month in profitability from this one asset.
Wow. That's upon 100% stabilization, right?
Correct.
Okay.
So in our underwriting document, we have a waterfall where it'll show each year 1 through 7 and look at the expected lease up duration, how that'll impact it. And we also make adjustments for anywhere from 2 to 3.5% rental increases year over year. So it'll factor in all that, and you can see exactly when it's going to hit its peak efficiency.
Now, when you get a loan from the bank, they would have their own formula for underwriting as well. Is that correct?
Yes, they would take a look at their own document renderings and then utilize that to offer it, both for the upfront financing and then when we refinance once stabilized to get a lower rate and dispose the refi capital.
Oh, sorry. Most likely are the formula that we have here and what the bank has kind of comparable, or would theirs be more conservative than what you have here?
It depends. I couldn't speak because every bank's going to be different on how they approach their underwriting. I can tell you that our means of underwriting is very conservative just by nature, as well as investors. So, if it's your personal money that you're putting into this, you're going to be darn sure that everything checks the box. You're going to stress deals. The sponsor for the banknote is going to look at extensively. So you'll have, 3 to 4 different entities that will stress the deal, look at the underwriting, verify the rates. Anyone who has a financial equity in the deal is going to be looking at it. So in my experience, you get a ton of feedback, and typically they all err on a much more conservative side. So that makes me go in there ready to take that on, because it does me no good to present something that's ideal if it's going to continue to get slashed down and either rejected or pushed back. So I try to start off very conservative and then basically under promise, over deliver.
Right. Okay, thanks.
Of course, Smitty. Thanks for the dialogue, guys. Diving in this portion here, you can see the acquisition price at 5 million. And then the CapEx at 1.7. So just factoring in $50 a square foot for the self-storage development, this could go as high as $60 to $80 a square foot, depending on the state of the land, the area of the country, and then if we're adding climate control versus not. So as I go back to sweep through this underwriting and firm it up, after talking with our operator S3, that said, hey, let's take a look at it at $70 a square foot for the development of those 2 new buildings, so we can increase it towards a climate control and have that edge in the market. Any other questions on the underwriting? Fortunately, this one's pretty simple. It's just really about building out those new facilities. We didn't have to really worry about additional paving, any kind of exterior facade, because this one was just erected in Q4 of 2022. Everything's brand new. So really the only cost would be the acquisition price, as well as any additional buildings that we're seeking to do. And down here, you can see the IRR, multiplier, refi capital. One thing to really note here is at just below 4, this has a really good return for investment. So if you put $100,000 into this deal, you would expect to receive $394,000 back at the end of the investment.
Oh, wow. So the previous people that had done the renovation, they were a flipper, right? They took the existing commercial building and they flipped into the storage units, and then now they're selling back to us, right?
So this was actually a ground up development.
Oh, ground up development.
Yeah. So if you look in this picture here, you can see it was actually just undeveloped land. So what this group did is they came in, they purchased this plot of lands, and they did the initial development of the self-storage facility. So they didn't want to take it all the way. They wanted to get, something applicable and be able to resell it for a financial gain. And by doing the value add, starting this process, they're able to minimize risk, get a healthy return, and then hand the ball off to someone else who's ready to go on and develop it. And that could just be the amount of capital they had to pursue this project. It could be the turnaround time they're looking for their investors. A lot of different factors at play.
Okay.
But you'll see this often too. Even projects I've worked on with our operator S3, they'll phase out different developments, meaning like, hey, we're going to buy a large plot of lands. We're going to get that first phase developed. We're going to lease that up. We're going to leverage that cash flow for additional projects to expand on in the future. So we can kind of segment it, hedge risk, and utilize an already cash flowing asset to produce further upgrades to it.
Wow, I learned a lot. Thank you.
And we'll see the same model with RV and boat storage. For example, if we have a retail asset that has a very large parking lot, let's say 12 acres, we may do 70% uncovered parking, 30% covered. As those covered parkings fully lease, we can go back in, add those canopies in, additional CapEx to continue to meet the market needs, and then really identify what's that stabilization point. When have we hit equilibrium? So that way we don't go in, put 50% in when maybe it's going to stabilize at a 60-40 split.
Okay.
So we're coming up to the top of the hour here, guys. I'm going to pause on that property, but just really want to give back to the group another way of looking at value add plays for existing self-storage facilities. I'd encourage you guys to look at big box retailers, anything over 40,000 square feet on at least 5 to 6 acres of lands. Existing self-storage facilities, we want to probably look for at least 5 to 6 acres as well. There's not a minimum size, But if it's 20, 30,000 square feet of existing self-storage, it's really about what's the expansion potential. And if you have any of those, please reach out to us. We're happy to take a look at these deals, just like we did with Manpreet today, and help kind of synergistically show you guys what to do and offer out partnerships or different types of support.
Thanks, Nick. Great
Thank you.
job. I was just looking at your underwriting at that price per unit of, I think, a little over $8,000 per unit. I don't think we could build something in California that cheap.
No, there's
Seriously.
not much you can build in California that cheap.
No. I was like, really? $8,000 a unit? That's incredible.
Yeah.
Huh.
No, we'll see if the sellers are open for that, what their appetite is.
Did you get any pricing guidance from the broker or nothing at all?
Not yet. I put the inquiry in today, so just waiting for that call back, and we'll kind of go from there. And they can help me understand the cash flow of the asset as it stands now, and that I think that'll largely determine what they're looking for as far as price.
Great. Keep us posted.
Will do.
Well, everyone, we're coming up to the top of the hour here. I appreciate each and every one of you joining today's call. If you have opportunities that you'd like us to take a peek at, present that to Christina and we'll get it teed up for the following Thursday's call. As always, God bless. You guys have a great day and a wonderful weekend. And I look forward to catching up with you guys next week.
Yeah. Thanks, Stevens. Thanks, Nick.
Take care.
All right. Take care, everyone. Have a good day.
You too.